Good morning. Hi, this is Dan Moorhead. I have my partners Paul Verata and Joey Krug with me here, and the rest of the investment team. Thanks so much for joining our introduction to blockchain investing call. The genesis of this call is we host a call monthly. And many years ago, we did a ton of introductory type work explaining what the opportunity is. And then we got deeper and deeper into the details. And over the last 6 or 8 months, each monthly call, we typically had industry experts, CEOs, really diving deep into very specific issues. And we heard back from some new LPs or some interested institutional investors that, every once in a while we should go back to doing kind of a more introductory call. So that's the spirit of this call, is to go back through why this is one of the most asymmetric, interesting opportunities, essentially of a generation. And our subsequent monthly calls next month and others will be, much deeper dive. During the call, I'm going to go over kind of the big picture opportunity, and then Joey will talk about why blockchain is important. Then we'll go into our funds themselves. Just some kind of housekeeping things. To the extent you're not on our mailing list, you can sign up on our website or by emailing ir@pantercapital.com. I will go into all of our various funds, but most of them are open to take subscriptions at the end of every calendar month. And with that, I wanted to give a bit of a background on the team and our history for those of you that aren't familiar with Pantera. We were established in 2003 and used to manage $1 billion of very normal hedge funds after I left Tiger Management when it wound down in 2000. And in 2013, we launched the first crypto fund in the US. That fund is up about 14,000%. And then we quickly launched the first blockchain-oriented venture fund, and then have launched other funds that invest in tokens. Our ICO fund invests in pre-auction tokens, and then the digital asset fund trades tokens once they're liquid. We closed on our third venture fund a couple of years ago. It's 175 million. We will be launching our fourth venture fund sometime in 2021. With that, I wanted to highlight my partners. Paul and I have been partnered together for 6 or 7 years. He has a very strong venture background. And 3 or 4 years ago, Joey joined the firm. Joey built the first ICO on Ethereum, and it's very well known in the space for having created Augur. So we have been partnered together for many years. It's been a great partnership. We have 20 other people in our team. We're mainly based in Silicon Valley, San Francisco, and Menlo Park. And the case for blockchain is, there's been various forms of money over the millennia. Some have been more effective than others. The era of fiat currencies, I think, is we're going to see probably a bad outcome from the end of that era, where paper money used to be convertible into scarce, non-quantitatively easable things like gold or silver. In the 70s, we experimented with printing extra pieces of paper that actually were not backed by or convertible. And I think that Bitcoin and other blockchains are essentially the next evolution in money. It's going to take decades. It's not going to replace paper money overnight, but it will ultimately have a major impact on money. And then the tokens that can be built on top of blockchains, particularly Ethereum, allow really interesting smart contract applications that are essentially kind of like digital companies. There's obviously some differences, but that is a good framework for thinking about it. And the next few slides are a couple of different ways that we found people really get the opportunity. And everyone has a different aha moment with Bitcoin and blockchain. One of my favorites is thinking about it as the final piece of the protocol puzzle that is the internet. And in the 90s, Milton Friedman said the only thing missing from the internet was an e-cash system. That's essentially what BTC is. It's a way to move money around without any of the, centralized oligopolies that control all the other payment rails. On the next slide is a visualization of those oligopolies. When I was in college, there were monopolists that controlled all the phone systems. And it was extremely expensive to make phone calls. You had to be very conscious of how much money you spent, because any American that wanted to make a phone call had to use AT&T. And at one point, AT&T was 16% of the market cap of the entire United States. And to call someone in the United Kingdom, you had to use British Telecom, extremely expensive. When we realized you could route voice over IP, the amount of traffic went up 6 orders of magnitude, and the price essentially went to free. And that's essentially what Bitcoin and other blockchains are. It's money over IP. It's the ability to route money around the oligopolist to control either credit cards or correspondent banking or remittance. And it will allow everyone on Earth to be able to send money to anyone else borderlessly, essentially free and essentially real time. And I think it will have the same impact that VoIP did on the quantity of telecommunication that was happening. The quantity of money transactions, and in particular micro transactions, is going to rise orders of magnitude over the next 10 or 20 years. And this next slide is a comparison of Bitcoin or other blockchains compared to existing wealth storage systems or payment systems. And essentially it's a superset of all those. It does essentially everything gold can do, but better. It does everything that fiat currencies can do, either in their electronic form or their cash form. And then, it's better, faster, and cheaper than the oligopolies that control the payment system. And the only thing it isn't good at is buying a latte right now. And, that's what people gripe about. Oh, Bitcoin isn't very effective for, buying a cup of coffee or whatever. That's the very last thing it'll be good at. So, that's one argument that's quick to get rid of it. So most of us living in the developed world don't think about paper money very much. With the money printing going on now, there's a little bit of talk about it, but it's kind of so slow and insidious, we don't notice the value of our money being debased. The next slide shows the price of fiat currencies, all the major ones, the yen, the euro, the British pound, priced in something that isn't quantitatively easable, ounces of gold. And you can see that, paper money has been debased, keeps being debased. It's hit a record low against gold recently. And I think that the macro situation, which we'll talk about at the end of the call, is going to drive an even bigger debasement of paper currency. So you want to be in things that the quantity can't be eased, like gold or Bitcoin or any other fixed quantity asset. And throughout my career, I've been investing in opportunities that are very, very asymmetric. Russian privatization, or Middle Eastern equities, or Argentine farmland, or Tesla Motors. Every 3 or 4 years, some interesting trade came along that was very asymmetric. This one is by far the biggest and most asymmetric. This is a visual representation of the opportunity. The cryptocurrency market cap right now is about $350 billion. It's competing with things that are much, much larger, orders of magnitude larger. Digital payments, wealth storage, even money. Again, most of us don't think too much about money, but I can imagine a world 20 years from now when everyone on Earth has some of their wealth stored in a Bitcoin or blockchain asset. And this asymmetric opportunity means obviously it's, it's very speculative trade. You could lose, a large fraction of your investment, but you could also make, 10, 20, 40x your investment, which is a very rare type of trade to find. And those are the types of trade that I've always been very interested in. The other thing that makes Bitcoin blockchain relevant to a portfolio is it's not correlated with anything else. And there really aren't any other major assets like this anymore. When I started trading, I was a bond trader, and I didn't really care at all what happened in commodities. Couldn't care less what happened in equities. I just came in every day and traded my bonds and didn't think anything about the rest of the world. But over the next 3 or 4 decades, portfolio theory has been so successful that essentially everybody has the same portfolio. And so when there is a risk event like this pandemic, and people need to reduce risk, they're essentially all just selling the same thing. And so all assets become highly correlated. And we've even had the chairman of the Fed talking about risk on, risk off. And that's basically what happens when everyone owns the same stuff. Since most institutional investors really don't hold a meaningful amount of blockchain assets on their balance sheet, it's still very uncorrelated. This graphic shows Bitcoin's correlation to all the major indices. or asset classes that other people trade, and shows that it's essentially zero. It's 0.08 on average against all these asset classes. Most of the rest of them are, highly correlated. The one small exception is that during crises, like in March, crypto does become highly correlated, but only for, on average, about 31 days, and then that correlation breaks down, as it has this time. It's now marching to its own drummer. So if you are managing institutional money and you're concerned about finding assets that are alpha generating and uncorrelated, Bitcoin and blockchain are the dream asset. Bitcoin, as a proxy for the industry, has a 9-year, 209% compound annual growth rate and essentially zero long-term correlation to stocks, bonds, commodities, everything else. So that is the simplest argument to have, 30 basis points of your portfolio in it. And with that, I want to hand it to Joey Krug to have him give his thesis on why blockchain is important.
Thanks, Dan. So if we go to this slide, you can see that it's more than just money. So different protocols and different cryptocurrencies are suited for different use cases, basically due to different design characteristics and trade-offs. So if you look at Bitcoin, it's a great store of value. It's great for sending money from point A to point B around the globe. The big kind of breakthrough with Bitcoin was that it solved this double spend problem, or how do you send somebody money while being sure that they're not able to spend the same money twice? So how do you solve the counterfeiting problem in digital world? And then next you have Ethereum. And the big innovation with Ethereum was really this idea of smart contracts. The idea that you could have these little computer programs that sort of automatically enforce certain rules and give you sort of the programmatic ability to do really any sort of financial transactions. One of the first things people did with Ethereum is they used that tech to basically launch new cryptocurrencies, because the barrier to entry to launching a new one became much lower once Ethereum came out. If you wanted to build a cryptocurrency that did some interesting thing, you could basically build it on top of Ethereum and just add the changes that you wanted, versus building your entire thing completely from scratch, which is how it was in the past. And so if we look, the market is sort of no longer just Bitcoin anymore. I remember back in 2013, 2014, 2015, there were other assets in the market, but they were so much smaller. It was sort of irrelevant. You just kind of bought Bitcoin and that's all there was to buy. Nowadays, there's a lot more cryptocurrencies. And even in the short amount of time since we've done a presentation like this, there's another big difference too, which is a lot of these new assets in the market actually have cash flows associated with them. So you can actually earn money from using them in some way, or staking them, or holding them, or whatever it may be. So they actually have usage and cash flows, which is another really big difference compared to just a year or two ago. And so if you look at something like Ethereum, developers can build all these interesting decentralized applications. You could eventually envision a sort of decentralized version of Uber, or really any sort of peer-to-peer marketplace. I think a large portion of these marketplaces in the future will be built on smart contract platforms, because it's sort of a natural fit. If you have a global marketplace of people who are transacting, Ethereum is a really good fit for that sort of use case. It's just today it doesn't scale too much, but it will in the future. And so if you look at this empirically, you can see that Bitcoin's percentage of the market sort of peaked in 2017 at just under 70%. And sorry, the non-Bitcoin share of the market peaked at just under 70%. And then it's been sort of declining for a while in the bear market, and then now it's starting to recover again. So right now, Bitcoin dominance is around 60%. Altcoins are around 40%. In any bull market in crypto, that kind of ebbs and flows. But eventually, I think the altcoin percentage is going to keep rising for quite some time. And so this slide basically goes over this kind of concept of like the internet of value. If you think about how the internet basically transformed consumption and creation of information, crypto is doing that, but for value and finance. So blockchain tech basically enables this global peer-to-peer marketplace where buyers and sellers can kind of transact directly in real time without any intermediary. And this will apply to eventually to things like real estate. It'll apply to financial transactions, trading stocks, commodities, bonds. Right now, it primarily applies to transactions just involving cryptocurrencies themselves. But like any new piece of technology, it kind of starts off as a toy and then morphs into kind of more expanded use cases that actually impact, kind of your daily lives. And so if we look at this concept, they're sort of known as decentralized applications. I think eventually we'll just drop the D part and just call them apps, like anything else. For a long time, people use the term web app. They'd say, oh, it's a web application. I think usage of that term is kind of starting to decline. You just call things applications. The same thing will be true in the blockchain space over time. And there's sort of a wider array of use cases you could use this stuff for. You can use it for everything from like online gaming, basically like gambling or betting, to like decentralized versions of Airbnb. There's a company called Brave, which we're an investor in, as a browser that basically sort of inverts the ad model that companies like Google have. It makes that more of an open marketplace. Filecoin's a really exciting one that launches in about a week or two, and that's a peer-to-peer marketplace for storage. They actually have a really large amount of storage on their platform, storage capacity. People kind of always said, well, how much could you actually store on Filecoin? Will it be like you be able to store any amount of data you want, sort of like how you can on Amazon? And the answer is actually a pretty resounding yes. The amount of storage capacity in Filecoin is like insanely large. I think it numbers in exabytes or something like that. It's a really high number. And then you have things like payments and a bunch of other DeFi kind of use cases, which we'll get to in the next slide. And so if we go to the next slide, if you think about how the internet sort of underpinned a new information infrastructure, blockchain tech and crypto, it's going to be the same thing for the underpinnings of a new financial infrastructure. If you look at kind of past information revolutions, things like radio, television, they didn't really democratize creation of new content. If you look at, TV or radio, not that many people are ever on TV or radio in their lives. In fact, the average person isn't. But with the internet, anybody can create content very easily. And so if you look at open finance, the kind of question to propose is, well, what does that look like? Where there's a financial system where anybody can either create or easily participate in new financial markets. And it looks a lot like how DeFi looks today. It's just very early, but kind of we're already seeing the first beginnings of this. And so there's really 5 components to any financial ecosystem. There's a unit of account. What asset are you trading in? Dan and I would love for everybody to just trade everything in Bitcoins. I think that's unlikely for a very long time. And so stable coins are really useful for this. Things like DAI and USDC, these are dollar-pegged assets on the blockchain, basically digital dollars. You need places to trade assets. So particularly trading assets without an intermediary. And that's what decentralized exchanges like Uniswap and 0x enable. The next piece is you actually need assets themselves. What are you going to trade? Right now, the 2 main categories of assets are basically like anything else, equity or like new assets and debt. And on the debt side, what people are doing is they're basically borrowing and lending other cryptocurrencies on platforms like Compound and Maker. And also Aave is another one. On the other side of things, assets that you would want to buy as an investment, there's not as many. There's like ERC20 tokens, but there's a huge world of like actual equity that could be tokenized in the blockchain that hasn't been yet. I think over the next 10 to 20 years, a large portion of it will be. The chairman of the SEC actually was recently talking about this very concept. I think it'll eventually happen. But the sort of like what we have today is basically just other tokens that are building other things in the cryptocurrency space. And the last 2 are margin and leverage. You can have a fully collateralized financial system with no margin or leverage, but it's not very interesting. A lot of like useful activity actually wouldn't occur. The simplest example is think of trading like, a currency pair like dollar yen at 1x leverage. Is not very exciting. You can't get that much exposure. And so there are valid reasons why you'd want to have either of those two components as well. But they're harder to do in a decentralized way because if something goes wrong, you can't just knock on somebody's door. It has to be entirely algorithmic. And so this is sort of an overview of what the DeFi space looks like. You really have a few different categories of things. You have aggregators and wallets. These are basically interfaces that will allow you to interact with DeFi. Yearn Finance and InstantApp are sort of the two main ones. Yearn or Yearn, you basically just give them your money and they manage it. You can do this for Ether, various stable coins, and they'll charge you a small fee on it. InstantApp is more kind of do it yourself. It's sort of more like the E-Trade model. You go there, they show you all the different things you can invest in. You choose the ones you like, you kind of do whatever you want to do. It's sort of like a broker or a bank, but if it were decentralized, then you had control over your own money. Decentralized derivatives exchanges are really important. Nobody's really quite cracked this problem yet, but I think it will be solved. Vega is one of our portfolio projects. They're supposed to go live sometime in the next few months. You have lending, which I already talked about. Decentralized exchanges. Decentralized exchanges is interesting. A year ago, their percentage of the centralized market share was very small. Now it's actually starting to become meaningful and real. There's been many days where Uniswap has done more volume than Coinbase. In fact, I think for the month of September, Uniswap actually did do more volume than Coinbase, which is really interesting. It's something that I didn't even think would happen this year. I thought that would eventually happen, but not yet, and it's already starting to happen. Marketplaces, which we talked about. Payments is a big one. When I first got into this space, everyone talked about how crypto is going to be used for payments. It would be used for remittances and all this stuff. And it didn't really happen for a very long time. Now it's sort of finally starting to happen. I would say the most successful one in the space is Terra. They're based in Korea and they power a lot of payment volume there. The last numbers I saw was like 4 billion annualized TPV or payment volume. I'm sure it's grown even more since then because that's like, a few weeks out of date. But they've actually gotten product market fit using crypto for payments in the Korean market and kind of eventually expanding outside of there, which is really exciting. You have oracles. How do you get real world data into the blockchain? That would kind of fit in one of the what are the biggest problems in the space to be solved? Well, if you imagine this kind of new parallel financial system, it does need to know some data about the real world. Augur uses oracles to figure out who won an election, or what was the price of something when it closed on the Friday closing bell. Chainlink uses oracles for things like what's the price of Ether, what's the price of Omise Go token, whatever it is. It gives you those prices on chain. The very kind of bottom is the layer one, or what actual blockchain are you building on? Ethereum is definitely the market leader right now. People are working on a bunch of different ways to scale Ethereum. There's also competitors to Ethereum, things like Polkadot, things like Near, projects like Cosmos, that are much more scalable but make different trade-offs. And all of those I think are actually working on bridges to Ethereum to get data to and from Ethereum, so that it might actually, you might have a world a few years from now where there's some projects on Polkadot, some on Near, some on Ethereum, and they all kind of interact with each other. This just shows how much DeFi has grown. It's really exponential. There's two main metrics you can look at. One is how much value is locked up in these DeFi protocols, and two is how much trading volume is actually happening here. And 2 years ago, there was only a couple 100 million locked up in DeFi projects. It spiked up to 12 billion earlier this year. I think it's at 11 or so right now, something like that, $11 billion. And then trading volumes, 2 years ago, it was a rounding error. I think it was basically non-existent for the most part. Now it's about $22 billion a month is flowing through these decentralized exchanges, and that's before scalability is really even here yet. I think once scalability happens, I think it's just going to continue to snowball, and DEX volumes will in some cases surpass centralized exchange volumes kind of really consistently. It's already happening for certain pairs and certain assets. And so our thesis basically is that the growth in DeFi is going to continue, and that, other than digital gold, it's sort of the most interesting use case for the space, and it's sort of the natural one that makes sense. If you think about, cryptocurrency allows you to send money from point A to point B. You add smart contracts on top of Ethereum. What does that enable? Well, it enables a new decentralized financial system. And with that, I'm going to pass it back to Dan to provide the macro case for crypto.
Thanks, Joey. The birth of Bitcoin was Satoshi printing a frustration about the last financial crisis in the first block of Bitcoin. Satoshi was pissed that the UK Chancellor had bailed out the banks again for 50 billion pounds. The US is printing that amount of money every 4 days now. So in March, our first letter after the pandemic got going, we said that Bitcoin was born in a financial crisis and will come of age in this crisis. And we really strongly believe that the macro case for Bitcoin has been there for 11 years, but the unprecedented printing of debt is really going to highlight and pull all that forward. And to put it in perspective, the US has printed more money in the month of June than it did in the first 2 centuries of its existence. That has to have an impact on assets whose prices are priced in paper money and whose quantity can't be changed. And with that, we're now starting to see that in the markets. The markets are responding, even the equity market is responding. And one of the most amazing developments over the last month or two is the chairman of the Federal Reserve is now promising to increase inflation and in fact double inflation. That's just such a wild concept. I remember a day when central banks used to fight inflation. With that, the US currently has a 1% inflation rate. They're saying they want to take it to at least 2% and to average 2% over a multi-year period. And since it's been below that for quite some time, and it is likely, according to these Wall Street forecasts, to be below that target for several more years, they're going to have to run inflation at 3 or 4% or higher for many years to get the inflation average up to 2%. That's similar to most countries. Most countries have very, very low inflation rates. And in order to do that, the task is not that difficult. Fighting inflation takes very concerted effort, takes some painful policies, takes many, many years. And not that many countries have been successful at fighting inflation. There's actually 13 countries. Ken Rogoff of Harvard did a great study on countries defaulting on debt via inflation. And there's only 13 countries that have not had high inflation over the last 200 years. So it's a very difficult thing to do. However, if you want to increase inflation, that is very easy to do. Zimbabwe and Venezuela are the current leaders in that field, but any central bank that wants to create inflation knows how to do it. The Fed is engaged doing it, and the effects are already being apparent. The next slide has the price of assets priced in paper money relative to the beginning of the year. And obviously there's been huge disruption, huge economic cost to this pandemic. And even with that, stocks are up. And to me, that's the clearest proof that there is so much cash sloshing around the system that it takes more pieces of paper money to buy the same assets. Even stocks where corporate earnings are down 30% this year, obviously it's a huge economic impact to corporations. And you even have corporations like Hertz, which has filed for bankruptcy, saying that they have absolutely no value, trying to, the SEC prohibited it, but trying to raise capital at $1 billion market cap. That has driven up the price of other assets. Gold's at an all-time record high, and then blockchain assets are rallying as well. We put some of the the more well-known ones. Bitcoin is up 49% when this was marked, but other smart contract things like Joey's project Augur are doing better than that. And Ethereum itself, is up 172%. So the case for blockchain taking over all these oligopoly payment channels was in place, and now the monetary impact is adding fuel to that fire. So we think the next 2 or 3 years is going to be a massive rally. We have 4 different funds that span the entire spectrum of types of blockchain assets. On the next slide, we have the current fund structure. We have a Bitcoin fund, which is a very efficient way for individuals and institutions to get exposure to Bitcoin itself. It's like an ETF, but it's permissible and much more efficient. Our digital asset fund and ICO fund, Joey will talk about, and then I'll close up by talking about the details of the Bitcoin fund itself. And with that, I'm going to hand it to Joey to talk about the digital asset fund.
Thanks, Dan. So the digital asset fund, the idea behind it is it's a actively managed hedge fund. It's multi-strategy and has really 2 main strategies within it, which we'll get into in a moment. And it trades the entire spectrum of publicly traded and liquid digital assets. The idea here is we're trading things that are sort of already in the market, that already exist. We're not investing kind of in super early stage projects, but with the caveat in mind that in crypto, everything is, fairly early stage. And so if we go to the next slide, we can see that there's 2 main components to the fund. There's a discretionary sleeve and a quantitative sleeve. On the discretionary sleeve, we're basically investing in the assets that we think are at the highest potential to basically beat Bitcoin's growth over the next couple of years. It tends to be pretty concentrated in the decentralized finance space. That's a bet that we've been taking for a while now. I'd say, within it, we own about, 15 or so different assets. And we sort of anchor the portfolio with Bitcoin and Ether. And then there's, this kind of other group of assets that are a bit more speculative that we think have higher upside for various reasons. Some of those assets we hold them for like a quarter or two, and other assets we hold for a very long time. It really depends on the scenario. The second piece is the quantitative sleeve, and the quantitative sleeve is pretty actively traded. It trades kind of on an hourly basis towards new portfolio targets, basically based on whether our models think we have enough alpha to sort of overcome trading cost in a given time window. And so if the signal's not very strong, we won't trade that hour. But if it is, the models will. And that's automatic, so we're not discretionarily trading that. It happens automatically, both in terms of the models and the actual order execution there. And so if we look at portfolio construction, we can see that relative to the market, we're taking a different bet with the digital asset fund. Most of the market is basically payments and store of value. So things like Bitcoin, Bitcoin Cash, et cetera. We're basically much more overweighting, basically just invert the weight for the most part. We're much more overweight smart contract platforms, decentralized finance, open finance, whatever you want to call it, because we think that's where the sort of most growth is going to be seen throughout this bull market. Next up is the ICO fund. And so for the ICO fund, we're investing on a discretionary basis into new blockchain protocols. This is very early. It's sort of at the earliest stage. They're, pre-auction if they're doing a public auction, or sort of in their first, couple private sales if they're just raising from private investors. And the idea is that within the crypto space, a lot of the best projects, just like in kind of traditional equities, most of the value is created when they're private. If you look at something like Polkadot, we did in 2017, it's up, I think, over 10x, and most of that value is created in the private markets. It's gone up as well in the liquid markets too, but it's much better to have owned that from the very beginning when it was private. And that's sort of the idea behind the ICO fund, is we're investing in these things at very favorable valuations much earlier. And one thing that's changed too is in 2017, you saw a lot of companies and projects doing ICOs where they didn't actually have a live product or much traction or anything like that. That's changed. Most of the projects doing ICOs now actually do have a live product that's something in the market that actually has a good amount of usage and traction. And on top of that, their valuations are much cheaper than they were back then as well. So it's sort of these two kind of combined positive factors that didn't exist in the market as much back in 2017. This slide is actually a good example of that. We're sort of beginning to see a resurgence in deal flow in the ICO space. It's starting to heat up a bit again. It's certainly not hot, by any means, but it's sort of, I'd say, a pretty healthy environment right now. You have projects like Injective, Acala, and Polkadot. Polkadot I mentioned already. Injective and Acala are two early stage projects we did. Injective is basically a decentralized exchange that supports really fast trading. So it's pretty high throughput and low latency. It supports margin trading, derivatives, and futures. And then you have Acala, which is the leading stablecoin and kind of decentralized exchange protocol on top of Polkadot. So we think Polkadot is going to get some usage. Acala is basically the leading flagship project on top of it. And so it made total sense to invest in Acala as well. I think Dan's going to go over the Bitcoin fund.
Thanks, Joey. So our first fund is a fund that is a passive tracker of Bitcoin. The decision was made in 2013 to use a Cayman hedge fund structure because that was obviously a very easy way to get an offering out there. And we did that because we believed it would take years and years to get an ETF approved. 7 years later, that's still the truth. ETFs are still not approved. The SEC's taken a fairly conservative stance on this. So our fund is just a very low cost way for institutions and individuals to get exposure to Bitcoin. The next slide has a comparison relative to some of the other products in the market. Our fund is essentially, better, faster, cheaper on all respects. It's daily liquidity, so investors can come in and out any US banking day. There's no lockups, so somebody could come in today and come out 3 days later if they've decided against staying in the fund. It has the lowest fee and expense ratio and is open to both US and non-US investors. With that, I wanted to just wrap up with an overview of all of our funds. We have 4 different projects, and each of those has an on and an offshore component, with the notable exception of the digital asset fund. Richard Dunn, my old colleague, asked if we have an offshore version of that. We don't. We've taken a more conservative and literal reading of US tax law. We're cognizant that most of our competitors offer active trading of cryptocurrencies to offshore accounts, but that exposes offshore accounts to US taxation. Anything that's not a security or traded on a registered commodity exchange is subject to taxation. So we have not done that. The rest of our funds are open for both on and offshore. The Bitcoin fund is daily, no lockups. You can come in and out as quickly as you want. The hedge funds are all monthly subscription, and then one can submit a redemption each quarter. And then venture is 10-year lockup, private equity style. The third venture fund is closed, and sometime in 2021, we'll launch our 4th fund. And with that, I want to just go to the last slide of our question section. We have answered a lot of the questions in the Q&A box. We're happy to stay on to answer them live as we go. There were a couple of questions that I wanted to take live, and then Joey will take some as well. One of the questions about government intervention making these technologies illegal because they aren't aligned with the central bank and government objectives. I actually think we're pretty far past that point. Obviously, 6, 7, 8 years ago, there was a real and present danger that governments would essentially outlaw Bitcoin or other nascent blockchains. There is some sense that in the very, very long run, these will compete with currencies. And obviously, governments have enjoyed being able to print money. It's been a good business line for most governments. But, like I talked to the head of research at the Fed in 2013, and he was very clear that the US is laissez-faire about crypto, and they still are. The US, doesn't really do anything to aggressively help Bitcoin or other cryptocurrencies, but it certainly doesn't do anything to kind of unfairly disadvantage it. And so I think you're going to see a world where governments essentially accept cryptocurrency's existence. Some are going to be very progressive and try and have their own cryptocurrencies. Like China has a very national policy to create their own cryptocurrency. I'm not so convinced the US will do that, but it'll allow private market participants like Circle and Coinbase have done. USDC, which has 3 billion of assets in a stablecoin. Also, Facebook's leading a coalition of 100 entities to build Libra, which is a stablecoin based on US and other currency assets. So I don't think the governments are going to do much against it. And there was a question about power consumption being a long-term risk for BTC. I think the answer is yes. Bitcoin already consumes 0.2% of all the electricity that is produced on Earth. And the consumption of electricity is purely tied to the price of Bitcoin. If the price of Bitcoin goes up 10x, the amount of electricity that will be purchased will go up 10x. That's just the way capitalism works. And at that level, that can work. But if it went up another 10x, it seems like that would become problematic. So I do think that Bitcoin's obviously the most important cryptocurrency, but I don't believe it's going to be 100% of the market 10 years from now. I think other proof of stake blockchains will increase in market share relative to Bitcoin over those years. And with that, I want to hand it back to Joey to answer a couple of questions live, and then I'll take some more at the end.
Awesome. Yeah, there's some interesting questions about like evaluating projects. Like, do you need to have a computer science major to evaluate a cryptocurrency project, and or what criteria should you use to evaluate these opportunities? I think only a very small part of it has anything to do with computer science per se. Like, we do look at the code of projects we're investing in, but it's mostly to see like whether it's actually high quality or not, or whether it's just really sloppily put together, that sort of thing. Is it actually real what they're building, or that sort of thing as well. But I'd say the most important things to look at are what you'd look at in any early stage investment, or really any investment in general. Those are things like quality of the team. What is the product that they're building? Does it actually make sense? How big is the potential market size? If it's a small market, can they expand and take market share into other larger markets? And I think the team is sort of the most important, because all of this stuff is very, very early stage. In terms of fundamental data that we track, I mean, we do look at things like how much GitHub activity is happening for certain projects. Like in the digital asset fund recently, we sold a position because the GitHub activity essentially ground to a standstill on it. And so things like that are things that we do look at, but it's not like we're sitting down and reading code for hours on end every night, and that's how we make our investments. Another one is about layer 2 scaling solutions for Ethereum. Which projects do we like the most? Which do we think will prevail? And how far are we from a roll-up centric Ethereum? So basically, for context, for anybody who's not familiar, these layer 2 scaling solutions, it's the idea of like, how do you do transactions on Ethereum in a way where it's really fast, it's really cheap, but you don't have to like necessarily trust anyone either. And so there's a bunch of different proposals and ideas for how to do this. I think the ones that I like the most, there's one called Arbitrum that we invested into, or Off-Chain Labs is another, they changed the name. The other one is Optimism, is the other one that's farthest along. I think one of these folks will ship before the end of the year. And after that, it's really just, the game is making it easier for developers to use it. But at that point, it should be possible to build scalable applications on top of Ethereum, which is really exciting, and it's something we've been waiting like 5 years for. It's a long time coming, but it'll actually be here, and it makes it a lot easier to build all these exciting applications that we've been talking about.
Joey, I'll take one that someone asked about. The macro thesis seems to be that global printing of money will drive fixed supply assets higher. equivalent to saying inflation will occur. However, the bond market's pricing very low inflation. There's a huge important difference in inflation. There's inflation in fixed quantity assets like gold or Bitcoin, and there's a completely different inflation, the one most of us typically think about, consumer price inflation, which is a basket of goods and services, which is not fixed quantity. There's a limitless amount of flat screen TVs that can be created on Earth. And so with this huge slack in the economy and with tens of millions of people unemployed, I actually think there's going to be very little inflation in, as measured by the CPI in the US or similar measures abroad, which is mainly goods and services, like flip-flops or flat screen TVs. Those aren't going to go up in price. However, things that are in fixed quantity, like real estate, gold, Bitcoin, fine art, those things, you can't just keep printing more and more of them with empty factories or people seeking to get out of unemployment. So there will be massive inflation in certain things, and then in goods and services, there probably won't be very much inflation. And that'll be another reason to be very bullish on these fixed price things, because the Fed explicitly targets the US CPI index. And it's going to be very hard to get that index to go up. In order to get that index to go up a lot, which is what the Fed's stated goal is, you're going to have to make gold go up a tremendous amount and make Bitcoin go up a tremendous amount. Oh, and there's another question on whether there exists institutional grade prime brokers for cryptocurrency strategies. There are a handful of firms like Amber and Tagomi that are, providing the basics of that type of functionality, order routing, helping firms like Pantera, execute across 20 or 30 different exchanges. But it is early days, admittedly, and none of the kind of main Wall Street firms are yet doing that. A huge development in our industry happened a few months ago when the OCC, which regulates nationally chartered banks, gave permission for nationally chartered banks to custody cryptocurrency. That's not going to open a floodgate where you see, the top 3 banks in the U.S. do crypto tomorrow, but there's 5,000 banks in the U.S. You're going to start seeing some of them start to do that, and I'd say over the next 2 or 3 years, you're going to see, major Wall Street firms providing normal prime brokerage type services for cryptocurrencies. Joe, I'll give it back to you if you have a couple questions you want to answer.
Oh yeah, there's one. It's how does Pantera measure product market fit for crypto networks? And so that's a really great question, actually. There's a couple different ways. One is through actual number of unique users. That's of course since it's Ethereum, you can make a bunch of addresses, so you can always spoof that. So it's really not about looking at one indicator in isolation, but looking at a composite of them to see what's actually going on. But one of them is number of unique wallets interacting with an application. 2 is volume. If it's a trading-based application, how much trading volume is going through it. Well, obviously looking to make sure that there's not wash trading going on, or if there is, to exclude it from the data set so you can see what the real volume is. And then the third is how much capital is locked up in these protocols, and also how sticky is the capital. Has there been $1 billion locked up for many months in a certain protocol? Like Maker is a good example where that's basically true. Or is it something that just kind of came there overnight and might leave in the morning? Something like Sushi Swap, where they got a bunch of TVL or value locked up, but it all kind of, or not all of it, but a large portion of it went away after their rewards decreased. So looking at kind of what are the sustainable metrics for product market fit, how does that translate to potential value for token holders, that sort of thing. There's another question. It's what are the areas in DeFi that Pantera is excited about? I would say lending is a big one. Decentralized exchanges is another one, and stablecoins. Stablecoins basically give you digital dollars on the blockchain, which is really, really cool. Whenever you use one, it's kind of like a shocking experience because you can send somebody money across the globe denominated in US dollars. It arrives pretty much instantly at very low fees. And it's kind of a crazy experience because you can do it whenever you want, 24/7, at any time of day or night. There's no banking hours, that sort of thing. And that's true for the rest of DeFi as well, whether it's a decentralized exchange or lending protocol. Basically, anything that's sort of like a core component of a financial system is something that we're interested in on the DeFi side of things, because we think this is going to be sort of this new parallel financial system. Newspapers didn't die overnight when the internet was created, but I'd rather be investing in the internet than investing in newspapers.
Joey, I'll take a couple. There's a question about our position on mining, and that's essentially the only business we haven't invested in over the last 7 years. It's just such a dangerous business. I've seen 40 pitches from very reputable chip designers that come with incredible pedigrees, talking about how they have the best chip, but the ability to fabricate, roll out, and manage mining is very, very dicey business. And then ultimately they keep reinvesting their profits into the next generation of chips, and in most cases ultimately they end up blowing up. So it is very difficult business to invest in. There's another question about countering the argument about cryptocurrencies being used for illegal purposes. Criminals commit crimes. That's their job. They originally started using Bitcoin because they thought it was anonymous. It's not. It's actually a terrible thing for committing crimes. It has a permanent paper trail of every transaction that's ever happened, which is a horrible feature for committing crimes. We saw that with 2 federal agents. They were on the Silk Road Task Force, were using Bitcoin to commit crimes. Bitstamp turned them into the government, and now they're doing 10 years in prison. The guy from BTCE, the exchange that was laundering money from the Mt. Gox hack, was arrested. It really is a terrible thing for committing crimes. There's still probably 1 or 2% of Bitcoin is used for committing crimes, but that's very similar to cash. A meaningful fraction of cash is used for committing crimes. And there's actually a department of the Federal Reserve in San Francisco that's in charge of destroying bills that have become too toxic from all the crimes they've been involved in. So it's an issue, but I don't think it's any different than any other form of payment system. Someone asked, how do I start investing with Pantera? Our investor relations department's ir@panteracapital.com, or you can register your interest on our website, and be happy to send you information on our 4 different styles of funds. And with that, I'll hand it back to Joey for a couple more questions.
There's a couple here that are like, what's the earliest stage we invest in a DeFi protocol, and how do we think about security, and do we help people like find product market fit? I'd say there's really no stage that's too early for us. We've been the first check into companies. We've also done stuff in the later side of things. So when it comes to DeFi, we've done kind of, basically wide range of stages. And so, yeah, so any stage is fine. Smart contract security, that's definitely always something to be concerned about. Security is important in any company. It's really important in crypto because there's just sort of less guardrails. Like you can't update contracts as easily on Ethereum, that sort of thing. That's why audits are really important. That's why automated tools for finding vulnerabilities is really important. There's not a whole lot you can do besides that. Something's been battle tested for a long time. It's likely secure. And that's just sort of one of the risks of investing in the crypto space. Although at Pantera, we don't really have much money in smart contracts at any point in time. So we're mostly just exposed to the risk in the sense that we buy assets that are like these smart contract protocols, but we don't have our money for the most part in a bunch of smart contracts at any point in time. For product market fit, we'll do what we can. Product market fit is sort of a dance between what the company's doing and the market. If it's something where we can introduce you to somebody, like it's a B2B thing, that's definitely much easier to sort of manufacture product market fit by getting you in front of the right people and that sort of thing. But for consumer stuff, a lot of it's just sort of listening to the market and iterating based off that. We're happy to provide you advice and kind of strategize with you. But it's that one's harder to kind of manufacture.
Joey, I'll take a couple. There's a question about will a digital dollar usher in, more interest in crypto? I think it's unambiguously yes, that if you have either Facebook's Libra or the U.S. government doing a U.S. Central bank coin, those are all net positive. Obviously, there's a little bit of cannibalization of the market, but if you're, excited about Bitcoin blockchain, maybe there's, 100 million people using it at most right now. If you get any entity like, Facebook, that's going to bring billions of people into the industry, it's got to have a net positive impact. And then it's important to state I don't believe this is a winner take all situation. There's, dozens of different use cases. There's already, thousands of different blockchains. Having another one, a stable coin is it's not an existential threat for Bitcoin itself. Stable coins have the advantage of, all the advantages of tokens, borderless, easy to send, instantaneous, all that, but then they don't have the price volatility. As an investor, I like the price volatility of cryptocurrencies, so that's why we're investing in them. But, people that just want to remit money or they just want to, make payments, stablecoin has great advantages. So I think they're symbiotic, that as stablecoins grow, they're going to bring more people into the blockchain space, and that will get more people thinking about, investing in cryptocurrencies themselves. There were a bunch of questions like, what are the potential liabilities for fiduciaries using or investing in the public blockchains? How can fiduciaries use public blockchains, minimizing liability? The reality is, we now are in an environment where there are incredibly secure, regulated custodians. That wasn't true 3 years ago, and it certainly wasn't true 7 years ago. And so the argument that was, had some validity, 4 or 5 years ago, is like, hey, I can't invest in this space because it's too, too scary. There aren't any regulated custodians. Part of the answer to that would be, well, that's risk and reward go together. So obviously there's going to be more reward when you're taking a bit of risk. And now you have entities like Fidelity, the New York Stock Exchange is company backed, BitGo, Coinbase, all doing highly regulated, very secure custody. Really removes that last, reason why institutional investors might not want to invest. And one investor misheard my suggestion to put maybe 30 basis points of a portfolio into blockchain and asked if they should put 30%. If you're, if you're wildly bullish on blockchain, that'd be great, but not for a huge institution. The question about commenting on the crackdown on BitMEX and other exchanges, it's just a natural evolution of a young industry, right? Cryptocurrency was essentially the Wild West 10 years ago. And there's kind of a Darwinism taking place where the exchanges that do great security and abide by the rules that the powerful countries want will continue to grow and thrive. And Bitstamp, Coinbase, all these exchanges are doing really well. And the ones that tread on the periphery or maybe completely outside the bounds of what isn't accepted, they can make a ton of money in a very short period of time, but they're probably not going to be here in the long run. And that's ultimately great for the industry. 98% of people want to use Bitcoin and cryptocurrency for completely legitimate purposes. And so, essentially cleaning up the bad actors is a good thing for the industry as a whole. And Joey, I'll let you have a chance to answer.
Awesome. Let's see. There's one question that a couple of people have actually asked about. It says, like sort of in the time frame of printed news, radio, TV, internet, etc., where would you place crypto today? Could it be that you're too early? And I think, yeah, I think that's probably one of the biggest risks in crypto is that we're too early. Obviously, I don't think we are, but it's a risk. I think it's a bigger risk than the regulatory one that Dan just talked about. And the risk is essentially that, you know, it takes longer to scale than we thought, and that due to that, it kind of halts a lot of usage, and it doesn't really take off until somebody solves that problem, and it takes a lot longer to solve than we thought. I think that's pretty unlikely at this point. If you asked me 2 years ago, I would have said it was a huge risk. Now I'd say it's a pretty small risk, because a lot of the projects that are working on scalability, they're already they've already shipped test networks, and they're just working through, you know, small bugs and things like that before launching main networks. And in fact, one of these projects has actually already launched a main network called Matic Network. And they allow you to do kind of really scalable Ethereum transfers and things like that on their basically Plasma sidechain to Ethereum. And so this stuff's happening. It may take a little bit longer than we thought, but I don't think it's going to take that much longer. Somebody asked about beyond DeFi, what areas are we excited about? I think I would say like infrastructure is a really big theme in our portfolio. You know, things like, you know, companies that make it easier to get access to crypto, exchanges in different geographies, companies that are working on tech infrastructure that make it easier for developers to build and write projects in the space. That sort of stuff I think is all super exciting. You know, any company that sort of bridges this sort of old financial system with the new one, I think is a really important company to invest in, and those companies are going to make a lot of money. It's going to be many decades before, you know, people get paid in cryptocurrency straight onto Ethereum. That may never happen, actually. And so I think these companies are a pretty solid investment, you know, the bridges between the two different worlds.
There's one question on the minimum investment amount and what is the shortest term I can invest. Our minimums are typically, we try and keep our minimums very accessible, and so they're typically $100,000. A couple of funds have slightly different ones, but it's roughly that. So if you're interested and you're right around that level, shoot us an email. We'll confirm based on your geography and which fund you're interested in, whether it can be a different minimum. And I think with that, we've answered most of the questions. We have a handful that are still open, but in interest of everyone's time, we want to wrap this up to let you get on to your next thing. If we didn't answer your question at the end of the session, feel free to shoot it to ir@panteracapital.com. And then next month, we are going to have a more detailed monthly call. It is deconstructing DeFi. It will be on the 3rd of November. And in that call, we'll have Akala, one of our portfolio companies, dig deep on DeFi. And so, you know, we'd love to have you rejoin us there. And thank you very much for joining us today.